In this video we are going to talk about monthly dividend stocks that pay your rent. So before starting this video, please like this video and subscribe to this channel for our future updates. Losing money during a short-term stock market sell-off, such as the one we're seeing now, is painful. However, running out of money in retirement is a terrible prospect. That may appear to be self-evident. After all, running out of money at any point isn't exactly a pleasurable experience. However, the difficulty with running out of money in retirement is that you are no longer able to take on more employment or make sacrifices. While some seniors can afford to splurge, the majority of them are more concerned with purchasing food, paying property taxes, and visiting the doctor. Number 1. Realty Income O. Dividend yield, 3.8% at the moment. Realty Income, NYSE smiley face, is probably the most well-known of the monthly dividend payers, and it is certainly the largest. It's even registered the tagline "the monthly dividend company" as a trademark. The appeal of O stock extends beyond its monthly dividends. Realty Income has been a standout performer over the last decade, with a share price that has risen 160% or more without dividends since 2008, compared to a 10-year return of about 90% for the broader S&P 500 index. Given the market's choppy nature in 2018, it may be difficult for O stock to repeat that success in the future. Some investors were already concerned that the company was becoming overbought as it became a popular trade in recent years, and those concerns remain. But there's cause to be optimistic, especially for new investors, now that O stock has recovered 12% from its early October lows. In addition, Realty Income named Sumit Roy as the company's new CEO, following John P. Case. Roy formerly worked as an investment banker, where he oversaw real estate capital markets worth $57 billion. Realty Income has a well-balanced tenant portfolio, with about 12% of revenue coming from Walgreens Boots Alliance, NASDAQ, WBA, and 7-Eleven, two world-class companies that aren't going anywhere. There's a lot to like about this stable REIT. With a high dividend, the fact that you are paid on a monthly basis is an added plus. Number 2. US high dividend low volatility at HDLV. Dividend yield, 10.3% at the moment. Because it is a leveraged fund that uses financial engineering to theoretically double the yield of its components, the ETRAX monthly pay 2's leveraged US high dividend low volatility at NYSERCA, HDLV, adds a little spice to a monthly payment portfolio. It's not a typical approach, and it comes with its own set of dangers, but the rewards are evident, with a current yield of more than 11% before taxes and fees. There are some intriguing potential benefits for those prepared to assume such risks. HDLV invests in high-yielding stocks such as Verizon, NYSE, VZ, AT&T, NYSE-T, and Duke Energy Corporation, NYSE, DUC, NYSE, DUC. Sure, each of these has its own set of difficulties, but they aren't going away anytime soon. Because this fund owns multiple of these brands, you'll benefit from built-in diversification rather than placing all your eggs in one basket. There isn't really a better alternative out there if you want huge monthly payouts. Number 3. LTC Properties, LTC. Dividend yield, 5% at the moment. LTC Properties, NYSE, LTC, has begun to retrace its steps following the market's turbulence in early 2018 and again in October. And there's reason to assume that the company's long-term performance and generous dividend will propel it to long-term success, and fresh money could still find a terrific value in this cheap real estate investment trust right now. LTC owns senior housing and healthcare properties, including assisted living homes and skilled nursing institutions split roughly 50-50. With the baby boom generation still approaching retirement and living longer, demand for such services is only expected to rise. LTC hasn't increased its dividend as aggressively as other REITs, with its 19-cent distribution remaining steady since a 1-penny boost in 2016. However, the income potential is really excellent, with a current yield of about 5% and a sustainable payout ratio. The monthly dividend is a lovely touch, but what's more essential is that LTC appears to be a secure, stable income option, given its long-term healthcare exposure and the United States' aging demographics. Number 4. Main Street Capital, Maine. Dividend yield, 6.1% at the moment. With a monthly dividend yield of 6%, Main Street Capital Corporation, NYSE, Maine, is a solid income investment. Maine, as a mid-sized investment business, has a diversified debt and small private equity portfolio that is shielded against any individual risks to specific companies while also putting it in a strong position to profit from the American economy's rising tide. That is, for the most part, correct. Main Street has a proven track record, having invested in everything from software companies to an Arizona pizza chain to a variety of manufacturing. Main Street's investment income is increasing, and it is supplementing its monthly dividends with semi-annual payments. One point to consider is that Main stock is currently trading at a moderate premium to net asset value, suggesting that it may not be a good bet if the economy continues to deteriorate. Despite the skeptics, the reflation trade continued in 2017 and into 2018, and a reduced corporate tax rate and good consumer indicators promise well for this selection moving forward. In the big view, cyclical investments like this have performed well as the U.S. economy has ramped up. As a result, both the asset value and dividends are expected to rise in the future, with Main Street continuing to be one of the most successful company development companies in the world. Number 5. Shaw Communications, SJR. Dividend yield, 4.4% at the moment. Shaw Communications, NYSE, SJR, is the fourth largest telecommunications company in Canada. That may not sound like a glowing recommendation, but with a dividend yield of nearly 5% and consistent monthly dividends, it's just the kind of drowsy, but dependable investment you're looking for if income is your top priority. Given its relatively poor growth prospects but impressive stability, Shaw is an intriguing investment at current levels. SJR stock has dropped 18% this year, but it appears to have bottomed as the market has become more unpredictable. Shaw's prior acquisition of Wine Mobile, now Freedom Mobile, helped it diversify its wireless, wireline, and cable services, and the subsequent sale of the ViaWest data center business allowed it to deleverage its balance sheet and focus more intently on its consumer business. There's also a chance that aggressive low-cost wireless options, similar to how T-Mobile, NYSE, PCS, earned points in the war with Verizon and AT&T, may allow Shaw to grab market share from the big guys. The company announced more than 85,000 new wireless subscribers, and a 9% increase in ARPU in its most recent quarter, so there's reason to believe this growth approach will pay off in the long run. Furthermore, this wireless expansion assures that the monthly dividend is preserved and grows. Number 6. Apple Hospitality REIT, Apple. 7.4% current dividend yield. Apple Hospitality REIT, NYSE, Apple, owns 241 hotels in the United States, which are managed by two major companies, Hilton Worldwide Holdings, NYSE, HLT, and Marriott International, NYSE, MAR, NASDAQ, MAR. The portfolio is well diversified across the U.S., with Apple's largest footprint in Texas, California, and Florida, in that order. Apple mostly caters to urban and suburban customers, with a focus on business travel rather than tourism. Apple went public in 2015, and the results have been mixed so far. Despite fluctuating between $20 and $16 per share, the stock is still trading at a discount to its IPO price. But keep in mind that real estate investment trusts aren't built to provide tremendous growth. They're made to provide safe, consistent income streams, and Apple Hospitality delivers just that. There's a potential that robust consumer growth in the United States will eventually translate into a boost for the hotel business. In the meantime, Apple stockholders may count on a tasty dividend of roughly 7.5%, paid monthly. Number 7. Pembina, PBA. Dividend yield, 4.8% at the moment. Before you dismiss the inclusion of an energy stock, keep in mind that this is a pipeline company, not an exploration company. As a result, it's essentially a glorified toll collector in the industry with no exposure to the risk of shifting crude oil prices. Pembina Pipeline Corp., NYSE, PBA, is a Canadian pipeline company that transports crude from oil sands deposits in western provinces. The pipeline business's toll-taker structure provides more stability and less susceptibility to oil prices than ONG Wildcatters, albeit PBA has experienced a lot of volatility over the last 3 years, and its stock is down around 6% this year. The problem is that Pembina pays its dividends in Canadian dollars, resulting in some distribution instability. Ownership in a tax-free account is likewise a superior option, however, because the yield is currently at 5% and could climb in the future, any potential currency risk is a minor worry here. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.